Hello and welcome to AI Market News by LM. Today we are diving straight into what can only be described as a historic disruption to the global energy markets. Seriously, the headline here is Global Oil Shock. UAE quits OPEC. OPEC dying, and it is an absolutely massive deal. Let's break down exactly what this geopolitical earthquake means for our broad market outlook. For decades, OPEC has been the stabilizing anchor of global oil production, dictating supply to maintain equilibrium. But now, we're witnessing an unprecedented fracture. Coupled with an escalating naval blockade in the Strait of Hormuz, we are staring down a scenario that could fundamentally rewrite the rules of global energy trade. We really have to unpack what happens when the pillars of the energy market crumble, and how that extreme volatility bleeds into every single corner of our financial system.
Based on the prepared resources, we are seeing an immediate and massive strain on global energy transit. The U.S. is readying for a prolonged naval blockade of Iran, which is leaving supertankers idling indefinitely amid escalating tensions in the strait. This effectively cuts off a vital lifeline for Iranian oil exports to apply maximum economic pressure. But what does a prolonged blockade actually mean for the rest of the world? Well, the Strait of Hormuz is the world's most critical oil choke point. It handles roughly a fifth of global consumption. When supply chains freeze up here, energy transit routes become highly volatile, sending shockwaves across physical markets. Prolonged idling means massive insurance premiums, skyrocketing shipping costs, and a sudden, desperate scramble by importing nations to secure alternative energy sources before their reserves simply run dry.
To really grasp the magnitude of this historic 60-year split, we have to look at the UAE's core motivations. They want the ultimate freedom to expand daily production to 5 million barrels by 2027. Having already expanded capacity by 1 million barrels a day over the last 2 years alone, which is more than any other member, by the way, they felt severely constrained by OPEC's collective quotas. So the crucial point here is that they saw a strategic window to break free and act as a totally independent producer. The UAE has invested heavily in cutting-edge energy infrastructure, aiming to maximize revenue while transitioning their broader economy. Being tethered to collective production cuts was essentially a straitjacket on their long-term economic strategy. By stepping away, they can fully unleash their production capabilities, drastically altering the power dynamics within the Middle East and proving that individual national interests are beginning to outweigh cartel loyalty.
So what's the immediate market reaction to these compounding events? It has been absolutely fierce. Brent crude just surged past that $111 per barrel threshold. With the UAE's exit and the ongoing blockade choking off supply through the Strait of Hormuz, the market is highly undersupplied. And this price action isn't just a number on a screen. It represents a serious squeeze on physical energy availability that will inevitably ripple into everyday inflation. When crude breaches $111, the cost dynamics for global manufacturing, aviation, and freight transportation fundamentally break down. This creates a relentless compounding inflationary pressure that eventually hits the end consumer. It forces businesses to aggressively reevaluate their profit margins, slashes corporate earnings guidance, and leaves central banks scrambling to adjust their economic forecasts in real time.
As seen in the provided information and discussed in various news commentary, satellite imagery confirms a really severe bottleneck forming right off the coast of Chabahar. We're talking about a massive cluster of supertankers stalled right outside the blockade line. The timeline here is absolutely critical. Iran's storage capacity could be completely full in just 10 to 20 days. Once those onshore and floating storage tanks top off, they're forced to physically shut in production, which supercharges the pressure on global supply chains. A forced shut-in is incredibly destructive. Capping active wells can lead to permanent pressure loss and reservoir damage. That means even if tensions were to miraculously ease tomorrow, the lag in restarting production would leave the market starved for millions of barrels exactly when seasonal demand is peaking.
Now, this macro energy shock is rapidly rippling outward into broad market sentiment. When we look at the CNN Fear and Greed Index, two components really stand out right now: safe haven demand and the VIX. As energy anxieties mount, capital is aggressively fleeing to safer assets. Simultaneously, the volatility index is spiking, which is a crystal clear signal that the broader market is bracing for severe economic turbulence. When physical commodities panic, that fear acts like a contagion across equities. Institutional portfolios begin hedging against worst-case scenarios, shifting away from speculative, high-beta plays and seeking shelter to weather the impending storm. The spike in the VIX tells us that options traders are paying massive premiums for downside protection, reflecting a collective realization that this oil shock is definitely not a short-term anomaly.
Drilling down into specific equity markets, we're seeing a distinct defensive rotation taking place. The NASDAQ is dragging the hardest, taking a 0.90% loss, while the small-cap Russell 2000 is taking a heavy 1.20% hit. Now, what's really interesting about this is that the Dow remains relatively flat, showing only a minor decline.
Capital is clearly rotating out of growth-heavy indices and seeking shelter from these compounding geopolitical pressures. The heavy industrials, legacy healthcare, and energy names typically housed in the Dow provide a defensive buffer during times of severe commodity inflation. Conversely, the Russell 20,000 is highly vulnerable because small-cap companies are incredibly sensitive to rising energy input costs and borrowing rates. They simply lack the pricing power to pass those expenses on to consumers without destroying demand.
According to the input sources, that pronounced pressure on the NASDAQ isn't just about the macroeconomic oil environment. It was actually accelerated by a massive 4% drop in the semiconductor index. This specialized pullback was sparked by reports that OpenAI missed its internal sales and user growth targets. Because the broader market has so heavily priced in the exponential growth of artificial intelligence, any lukewarm guidance sends immediate shockwaves through tech equities. The narrative bridge here is systemic vulnerability. Just as we are grappling with a massive energy shock, the very tech sector that has been carrying major indices on its back is suddenly showing fundamental cracks. This makes investors question if these vast, capital-intensive AI investments can truly deliver the immediate payoffs needed to justify current valuations in a highly inflationary environment.
All of these compounding fears are forcing a massive repricing in the global currency and bond markets. The eurusd is dipping to 1.1696, but far more concerning is the usdjpy creeping dangerously close to the 160 mark. Higher oil prices uniquely punish the energy-importing Japanese yen, exposing severe structural vulnerabilities for the Bank of Japan. Because Japan imports nearly all of its energy, $111 crude drastically accelerates their imported inflation. Most importantly, the 10-year Treasury yield is climbing to 4.354%, sending a clear signal that the bond market sees broader inflation risks mounting. Rising long-term yields indicate that the market expects inflation to stay stickier for longer, driven entirely by these soaring supply-side energy costs, which fundamentally changes the math for global equities.
Looking ahead at our upcoming economic schedule and referencing the data we typically track on platforms like investing.com, we are bracing for an absolutely massive macroeconomic week. We have a highly anticipated Fed Day, which notably marks Jerome Powell's final meeting of his term. The stakes here honestly couldn't be higher. He faces the daunting task of navigating an oil shock, tech sector fragility, and creeping inflation, all in his farewell policy address. Alongside this, we await critical outlooks from the European Central Bank and the Bank of England. Europe is acutely vulnerable to supply chain bottlenecks, so we will be watching closely to see if these central banks are forced to maintain a hawkish stance to combat imported inflation, even at the severe risk of inducing a regional recession.
These upcoming central bank decisions, combined with the ongoing oil shock and tech sector volatility, mean we have a highly complex market environment to navigate in the coming days. The intersection of geopolitics, energy scarcity, and slowing tech momentum requires us to remain incredibly vigilant in our macro analysis. Are we witnessing the final days of the old energy order? And if so, is our financial system truly prepared for what comes next? Thanks for watching. Don't forget to like and subscribe. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.